Well, thank you, everyone. I'm sure we're going to have some more folks joining us here, but today we're talking about selecting target markets for multifamily. I have some good points to go over here, and then towards the end, we're going to look at some good resources that we use to evaluate markets and to find the ones for us. Some websites, a lot of great data out there. If you do a quick Google search for just multifamily markets, target markets, everybody has a top 5 list, top 10 list. There's some spillover. A lot of folks like some of the same markets, but personally, there's folks that own condos or apartments in Boise, Idaho, and Alaska, all over the country. Different markets work for different folks. But we're going to go over some high level things that we look for and some data we do. If you could share in the chat, I'd like to make this an interactive webinar. What are some things that you look for when looking at markets? The first thing I want to address is markets that that we know. We're predominantly own multifamily in the Sun Belt. So North Carolina down to Florida, over to Texas, Southeast US, pretty hot market for multifamily. A lot of investors like the Sun Belt for many reasons. Growth, pretty stable politically, friendly for investors, weather, etc., job growth, incomes, etc. There's some significant supply and demand issues that we look at. We'll go over that later. We predominantly invest in Class A multifamily, being within 5 years old, pretty new stuff, higher rent. Some investors like Class B, Class C. There's some different metrics you look at there. Other factors are major employers in an area, in-migration, population growth, and income. If your median income is $40,000, you don't want to go in there with a asking rent of $2,500. It doesn't work. If your median income's 120, maybe you look at something in the $3,000 range per month. So the reason we don't go in some markets are governmental policies, rent control. Some of your Northeast cities have that, would make it very difficult to invest. A more longer horizon point we look at is the appreciation over time. Obviously, most people plan to buy and sell at some point in the future, be it 5 years, 10 years, 20 years. You want to make sure your asset is worth more then than it is now. Back to my main point, an area you know well or you get to know well. And a couple other sub points. You want to price out insurance rates, look at crime rates, access to police, fire, EMS. One of the things I was learning last week was insurance on multifamily is very much based on the proximity to a fire station or a fire hydrant. I think it's ranked like 0 to 10, 1 to 10. And the higher that is, the higher your insurance cost is, the lower your profit's going to be. So there's a million things to look at. Everybody has a different market they like. If you have one, again, drop it in the chat. We'd love to hear about it. But we're going to get into some of the supply and demand numbers, which is probably the top level we look at when evaluating multifamily. Let me share my screen here. There we go. All right, if you can see this is a piece put out by CBRE. CBRE is a phenomenal resource for data. A lot of the stuff they put out is public. Some of the stuff you need to get from a broker, a debt broker, whoever it is, but this piece is publicly available. Just Googled it. Supply demand is the #1 driver for when we look at new markets. If you have a market that there's 5,000 new units coming on board, and last year they only absorbed 3,000 units, that tells you there's going to be 2,000 vacant units. Vacant units means lower rents, more concessions, lower net income, not good for anybody. So unless there's a significant reason to go there, we would probably not look at that market. So some high level numbers. This is nationally. The vacancy rate last year in Q4 last year crept up 5.4%. It crept to 5.4%. There was 140,900 units completed last year and only 84,000 absorbed. Absorbed means moved into, obviously. So that tells me right there, there's 54,000-ish vacant units. Vacant units means concessions, low rent. That's not going to be good going forward. The next number would be year-over-year rent growth is down due to the last 2 points and investment volume. But some of the charts, I love a good chart. This chart goes 2020 through 2023. The light green is completions, the dark green is absorption. So in the first part of the pandemic, 2020, there was a lot more completions, not much absorption. And then in 21, mid 21, all the absorption started, I guess when the markets opened back up in late 2020, early 21, people started moving around more, getting out of the houses, moving to apartments. So the mid to latter part of 21, all the units were absorbed. Supply kind of dipped, completions dipped in 22, 23. And then over here, you're starting to see this increase in supply and the stabilized number for absorption. So you're going to have larger vacancies going forward. Something I was reading was saying through 2025, a lot of the absorptions are being delivered in 24 this year. Typically, multifamily properties take 2 to 3 years from start to finish, depending on permitting, construction timelines. So a project being delivered today started in 21, 22. There was a lot of constraints on supply in the last year or two. So if you go see these numbers here for Q2, 22, Q3, Q4 had lower absorptions. That's when banks started to tighten up on construction loans, rates went up. That's going to significantly constrain the supply coming online later this year and early next year on into 26. So I think you're going to see more of this kind of data going into 25 and 26 across the country. Here is net absorptions, gross. This doesn't tell the whole story. I would like to see this as a percentage because obviously the biggest one here is New York. New York can absorb 8,000 units easy. Smaller market like Minneapolis, 3,000 is a pretty big number for them. So I would like to see this as a proportion, but some of your top markets are Austin. Austin keeps popping up on these lists. A lot of job growth, a lot of in-migration, pretty friendly policies politically, good weather. Dallas, Houston, the 3 markets right there in Texas. Atlanta, pretty good markets. Phoenix gets a lot of press. I think they're having some significant vacancies out there due to oversupplies. You keep getting these headlines, and all of a sudden everybody goes there, builds the properties, and it's overbuilt. So some of these other smaller cities, a couple Northeast, another one Texas. Here's a good chart that I like. So this says completions and net absorptions for the 4 quarters. So this is for the full year 23. New York, Dallas, Austin, Houston. Again, 3 of the top 4 in Texas. There's a little bit of a gap between completions and absorptions. So New York had about 13,000 open. Dallas, about 9. Austin's only about 6,000. And based on the absorption rate, so if they absorb 6,000 units in Q4, that's going to dry up quickly. So that's going to drive more and more supply going forward. Again, these numbers, percentage of completions and absorption as inventory, they've had 5% of the entire multifamily properties come online that year. That's a major number. That may take some time to finish absorbing. So vacancy rates, obviously during 21, 2022, vacancies dropped, drove rents up. Great time for everybody. Right now, vacancies are getting back to kind of a 5.5%, which is pretty standard. Here's historical vacancies. Again, I see a trend line about 5%, 5.5%. This dip was obviously end of pandemic in kind of 2020 when people started getting back out, getting into places. So that dropped down to 2, 3, 4%, depending on what class you're in. Obviously, ABC is here, so they follow the same trend. Basically, we're still back to 5.4% vacancy, which I think is a historical pretty good number. The first part of this chart, 09, captures the last part of the financial crisis. So I would kind of rule out 9, 10, 11. So we're looking at 2011 through 2020. Other things we look for in target markets. The RealPage is great data as well. They deal a lot with multifamily operators and get some good data. So this is an interesting one. U.S. has 1.1 million more occupied apartments today than in 2020. There's a bigger population. More people are renting today due to housing prices, interest rates, etc. So this is something I would look at. Again, supply and demand. Fannie Mae has good data as well. Here's new constructions. So you can kind of see it really drop off here in 24. It kind of peaked in 23. But again, that's going to lean to vacancies in 25, less completions in 25, excuse me. Other things I would look at when looking at markets are job growth. If a large employer is coming to area, let's take Charleston, South Carolina, for example. They have Boeing is there, Volvo has a plant there, Mercedes has a plant there. There's some big tech employers coming to the area. Charleston's always on the top of people's lists for best cities to move to, quality of life, weather, etc. Cost of living is not bad in most parts of Charleston. Again, when I'm first looking at a market, is it an area we know? I'll look at supply and demand. We look at incomes. And then you want to drill down into a sub-market. You want to take, the MSA as a whole, find the pockets you like, and then try to find an asset in that pocket or build one. I mean, if development's your thing, get back into that. So let me take a minute here and see if we have any questions and pick back up. What are some, I'll ask a question for our viewers here. What are some markets that y'all look at and some top things that you look at when evaluating multifamily markets? We had a guy at one of our events a couple of years ago who lived in California who said, I will not invest with you if you invest in California for whatever reason. That's not a place we invest. Obviously, a lot of people like California. I'm sure the rents there are exceptional, but a lot of pros and cons there. So what are some areas y'all like to invest in and some reasons why? You could drop that in the chat. I'd like to see some of your thoughts as well. Some of the markets going forward that we personally like for the reasons I've already been over, markets we're already in. We like mid to major MSAs in the Southeast US. So North Carolina, I like Raleigh, Charlotte, and 20, 30 minutes outside of those. I like Columbia, South Carolina, Greenville, Charleston, South Carolina. Savannah, Georgia is getting a lot of press. They're having some job growth coming down there. I think there's a pretty high talent pool. Jacksonville, Florida is pretty big, maybe a little overbuilt. The west coast of Florida down there is pretty oversupplied from some data I'm reading. Orlando market's pretty hot. There's a lot of competition there. A lot of new properties coming on board. Once those get absorbed, I think that would be a good market in 25, 26. Going west, Tennessee, I'm seeing Chattanooga and Knoxville on a lot of lists. Chattanooga gets a lot of good press, good cost of living, good employment base. 1 second here. Nashville, kind of like Orlando. Nashville's a great market. You're getting a lot of in-migration there. It's had a lot of supply come online the last 6 to 12 months. So it might take some time for that to absorb. After that burns off, that's going to be a great market going into 25, 26, and long term. We're a strong believer in the Nashville market. Um, I think Huntsville, Alabama is a good spot. Maybe further down on some people's list, but it's got some tech jobs, some good income jobs, um, low cost of living, good weather, pretty easy political environment. Um, and then on into Texas. There's not many markets in Texas we don't like. I think Houston maybe is a bit oversupplied, but Houston again is like a 2 hour loop. It's huge. We like Dallas, Austin, uh, around Houston. There's some good pockets there. I probably wouldn't go much further west personally. Like I said, a lot of groups really like the Arizona markets. I like Denver. I think that's a good market. Um, Vincent said he likes areavibes.com for some good basic info. There's again, millions of websites with good data. Again, a couple I like are CBRE, RealPage. If you're paying for data, you're gonna get better quality data. There's a couple groups out there that you can subscribe to and get some really good data. You can drill down your markets based on your criteria, where you look at incomes, rent, supply, demand, absorption, you name it. You can drill down your target markets pretty easily. How about this? Another question for our viewers. What is a reason you would not go to a market, like a red flag? I would say for us, that would be an unusual decline in rent. You could have an area perhaps all of a sudden have high crime. You get some bad press. People want to leave, get out of there. Maybe an employer pulls out. You have some unemployment. Kind of drains the renter pool. Again, Jacob hit on the head. Declining population trends. Exactly. Thomas says, looks like smaller markets are some markets that are the exterior of large markets. Yeah, cost too high in town. I'm seeing a lot of that. And if we can go, let's take Charlotte, North Carolina. If there's a deal, it's $500,000 a door. You need to get $4,000 a month rent, just round numbers. Your tenant pool at that amount, the higher your rents get, the smaller your tenant pool gets, the more vacancies you're going to have. The inverse of that would be people that make that much money to be able to afford that are a little more insulated from getting fired, probably not living paycheck to paycheck. So that's, again, a reason we like Class A multifamily is we look for at least 3 times rent as far as the income number as a minimum. So if you're renting for $3,000 a month, we want to see $9,000 a month gross. Again, $2,000 a month. We want to see at least $6,000 a month. So a rent to income multiple is a good thing to look at. And a lot of our properties in the 4 to 5 range. The higher the multiple of income to rent is, the less move outs you're going to have due to people, job loss, perhaps in the event of a downturn, et cetera. So, but back to Thomas's point, I do think the cost in, CBDs, downtown urban areas are a bit high. Obviously, they work for some investors, but we do like, I don't want to say suburban, but right outside of town. In the path of growth, we have some assets that are a mile outside of the biggest part of town, but we really feel that growth corridor is kind of coming in that direction. And back to my previous point of appreciation, I think that's teeing those up for great long-term appreciation, rent growth, et cetera. So kind of buying in a gentrified area or an area that's heading that direction is good. Yeah, 3 times has been the norm. So hopefully 4 or 5. The higher that is, income to rent, the better off you are. General in-migration. I live in Myrtle's Inlet, South Carolina. It's 30 minutes south of Myrtle Beach. Myrtle Beach is probably not a market most investors have thought of, but it is the #1 in-migration town between now and 2040, percentage-wise. They're supposed to have another like 140,000 people move here in the next 16 years. So with that, you get some good headlines, good press. You can have investors come there, drive up supply. So our Colorado market's still clogged with local red tape. I can't specifically speak to that, but I've read some data on that on the Colorado markets in general. It goes back to government, not to get political, but you have to like the government in the area you're investing and make sure there's investor-friendly policies. Some properties in some states, typically out west, had longer eviction moratoriums during 2020, 21. People were staying there not paying rent for years, and due to politics, and that really affects investors. I couldn't imagine owning a property and 80% of tenants not paying rent for 2 years, and there's nothing you could have done about it. So I would say invest in markets or states that are friendlier to investors and owners than more tenant-friendly states. There's obviously a balance to strike there, but Texas and Florida come to mind. Very friendly states for business. Pretty tough states for taxes and insurance. So there's pros and cons. I think the places most people want to live are pretty high risk places for insurance. So along the coast, there's a stat like 90% of the population lives within 50 miles of the coast. That's where the insurance costs are higher. I mean, a property in Florida could have $500,000 a year in insurance costs, whereas that same property, inland in Georgia, North or South Carolina or Tennessee could be, $200,000. So, but likely your rents are higher because of that. So it kind of averages out. So, again, those are some high level points we look for when selecting multifamily markets. So supply and demand, keep up with that. I keep your finger on the pulse of supply and demand quarterly. It kind of trends like a wave. If construction starts peak this year, deliveries peak 2 years later, 3 years later. So you kind of keep your finger on the pulse of the flow of supply and demand really helps you to kind of understand the markets, see where growth is going, see where you want to go. So I see here one of the questions. A few tools, subscriptions have been mentioned for data. Can you summarize those again? Yeah, so Yardi, YARDI, is a phenomenal resource. They have great data. RealPage, most multifamily operators use RealPage for analytics. I think like live pricing. They change. A lot of multifamily properties change prices daily based on, it's kind of like cars, right? If the market's a few bucks lower, they lower the price, $4 that day or $7 a month, just to stay in line with where the market is. So Yardi is a pretty good one. Red IQ is pretty good data. RealPage is good data. CBRE is free. A lot of the stuff's free. Another idea is connect with a broker, a multifamily broker. And a lot of them, the larger broker houses have economists on staff that put out really good pieces. CBRE does. I'm sure all the big name brokers do. So that might be internal. I'm sure they could share it with you if you have a good relationship with them. There's some really good data there. Fannie Mae, obviously a lender, but they have good data they get more kind of the governmental reporting data. So some good data there as well. I'll go over a couple more that I like. I would say also just staying on top of the news, multifamily news. I mean, if you can subscribe to some newsletters, keep up some websites, follow some socials, but that is the best way to kind of keep up with the stuff. There's always more updated data coming out, so I would try to stay in front of that. If you have any more questions, feel free to email. My email is ed@passiveinvesting.com. We're happy to have you on here. Is Axio still real page? I'm not sure about that. So not have an answer for you. I'm sorry. All right. Well, if there's any more questions, happy to answer. Otherwise, thank you for your time, and we'll see y'all next week.